All right, today we're going to try and untangle the super complex web of rules that decide if you're a tax resident of India. And trust me, you want to get this right because if you get it wrong, the consequences are huge. We're talking about potentially paying Indian tax on your entire global income. So let's jump right in.
So, let's just ask the big question right up front. Does simply being in a country mean you have to pay tax there on everything you earn, all over the world? Well, in India, the answer is a big, fat, it depends. And it all boils down to one single, crucial concept. In that concept, it's called your residential status. This is like the very first thing the tax authorities look at, and it has absolutely nothing to do with your passport or your citizenship. Nope. It's all about one thing, and one thing only: counting the number of days you are physically present in India. This first big hurdle is called the basic condition, and that's where our whole story really begins.
Okay, so instead of thinking about these as some boring, dry legal rules, let's look at it from a different angle, a more strategic one. Think of it like this. The government has set up two distinct traps, and they're both designed with one goal in mind: to classify you as a resident.
Yeah, this quote we pulled from our source material, it just hits the nail on the head. You've got this fundamental conflict, right? The government's goal is to make you a resident so it can tax your global income. You, on the other hand, well, you'd much rather be a non-resident. So see, these aren't just conditions, they're traps. And this is a high-stakes game.
So, what are these two traps? Let's break them down. Trap number one is super simple. If you spend 182 days or more in India during a financial year, boom, you're caught. That's it, you're a resident. Now, if you manage to sidestep that one, the government has a second, sneakier trap. They ask two questions. First, were you in India for at least 60 days this year? And second, in the 4 years before this one, have you been in India for a combined total of 365 days or more? If the answer is yes to both of those, you're caught again. Fall into either trap and your resident status is locked in.
All right, let's put this into practice. Let's run a quick scenario here. Imagine someone who just loves visiting India, and they stay for exactly 100 days every single year, like clockwork. Okay, so what do you think? Take a guess. This year, they were in India for 100 days. And in the 4 years before that, well, that's 100 days each, for a total of 400 days. Did they fall into one of the traps, resident or non-resident?
Yep, they are a resident. And this is a perfect example of how this whole thing works. You see, they were smart. They totally avoided Trap 1 by staying way under 182 days. But Trap 2 got them. They were here for more than 60 days this year, 100 to be exact, and their total for the last 4 years was 400 days, which is way over the 365-day line. The government got them.
But what if I told you that for some people, the government only sets up one of those traps? Let's talk about the lucky ones, a small group of people who get to play by a much simpler and, frankly, a way more advantageous set of rules.
You heard that right. For these specific groups, that whole complicated second trap, the one with the 60 days and the 365 days, it's just gone. It's completely off the table. They only have to worry about that simple 182-day rule. I mean, this makes it so much harder for the government to call them a resident, which is a massive advantage in this game.
So who are these lucky folks? There are basically three groups. First, an Indian citizen who's leaving India for a job abroad. Second, an Indian citizen who is leaving to be a crew member on an Indian ship, and the Indian part is really important. And third, an Indian citizen or a person of Indian origin, what's known as a PIO, who lives abroad and is just coming to India for a visit. For these people, only Trap 1 matters.
But you knew it couldn't be that simple, right? Of course there's a catch. For these so-called lucky ones, the game suddenly changes if their income from Indian sources crosses a certain line.
And that magic number is 15 lakh rupees. And just to be super clear, we're not talking about their global income here. This is specifically the total income they earn from Indian sources during that financial year.
So the moment their Indian-sourced income crosses that 15 lakh mark, even by 1 rupee, the government brings Trap 2 back into the picture. But with a little twist. It's not the same old 60-day rule, it's something new just for them.
Okay, this table breaks it all down perfectly. Let's walk through this together. Look at the top row for everyone else. You're a resident if you fall into Trap 1, the 182-day rule, or Trap 2, the 365-day rule. Pretty standard. Now look at the middle row, our lucky ones who earn 15 lakhs or less from India. See that? Trap 2 just says, not applicable. It's gone. But for the high-earning lucky ones in that bottom row, Trap 2 is back. But look closely. The 60 days gets a pretty generous extension up to 120 days. So they still have a big advantage, but the net is just a little wider for them.
All right, now it's time for the fine print. Because in this game, oh man, the definitions matter. They matter a lot. Let's do a quick run-through of some crucial little details that can totally change the outcome.
Remember that special rule for people leaving India for a job? Well, the law says you have to be leaving for the purpose of employment, and that means you must already have a job offer signed and sealed. If you're leaving the country to look for a job, that's called a search for employment, and you don't get the exemption. It sounds like a tiny difference in wording, right? But the tax impact is absolutely huge.
And you got to be careful here, because a lot of things that feel like work-related travel just don't count. Heading abroad to attend a conference? Nope. Going to a seminar? Doesn't count. Even traveling for a crucial business meeting won't get you this exemption. The law is crystal clear. It's for when you're leaving to actually start working at a new job. Next up, what in the world is a person of Indian origin, or PIO? Well, this definition actually goes way back in time. You qualify as a PIO if you, or either of your parents, or any of your 4 grandparents were born in what's called undivided India. That means India before the partition on August 14, 1947. So, for example, if your grandfather was born in Lahore back in 1940, then for tax purposes, you're considered a PIO.
Counting your gaze is another place where the details are critical. Now, if you can prove the exact times you landed and took off, like with flight tickets, you can calculate your stay down to the hour. Every 24 hours you're in the country counts as 1 day. But what if you don't have that info? What if you can't prove the exact times? Well, the government has a simple and not very friendly default rule. They just count both the day you arrive and the day you leave as full days in India. All of a sudden, keeping those boarding passes starts to look like a really good idea, huh?
And finally, there's this really specific, kind of niche rule just for ship crew members. If you're an Indian citizen working on a foreign-bound ship, you sign a document called a Continuous Discharge Certificate, or a CDC. Here's the cool part. The entire time between the date you join the ship and the date you sign off on that certificate is simply taken out of your day count for India. It's like that whole period doesn't even exist for tax residency purposes.
Okay, so let's tie this all together. The bottom line is this. Figuring out your residential status isn't about just one thing. It's this whole mix of factors. A super detailed calculation of your days, the exact reason for your travel, your family history, and yeah, even how much money you make from Indian sources. All these little pieces have to lock together to figure out if you've been caught in the tax trap.
And all of this leaves us with one final thought. Now that you've seen the traps, the special exemptions, the income thresholds, and all the little bits of fine print, what do you think? Are these laws a fair system for figuring out who should pay tax? Or is it more like a complex maze, a game of strategy where the only way to win is to know the rules inside and out?